All right, we have 30 minutes of discussion, so I'll start with Richard.
Yeah, I found the paper fascinating. If I may, I'd like to give three related questions. First, your focus was on what was happening to new software, yet much of your discussion proceeded as if you were talking about what was happening in innovation much more broadly than in software. So my question at the start is software a particular case, or do you see developments going on across a much wider front of innovation that look like those in software? Second, and related, what led to the decline that you talked about, this dramatic decline in the cost of bringing new software to market? Again, is this something rather special to software, or is it more pervasive than that? I haven't, for example, heard commentary to the effect that the cost of bringing a new drug to market has declined at all, or a new semiconductor. So again, how general is this? What was special in the case of software, or is it special? And third, that at least in the case of software, these developments that you've described so fascinatingly would lead one to suggest, to suspect that a lot of the selection process on proposed innovations in virtually all fields and all times, the bulk of proposed innovations fail. That this has shifted from ex ante calculations when lots of funds were involved before anything could be brought to market, and you had screening going on there. Now it's cheap and it's easy, to ex post selection. So those are my three questions.
Okay, so the first thing is that I am speaking about the average effect here. Software is 50% of this activity and has historically been 50% of the activity, right? So whatever year we're talking about. And so essentially the story is that 50% has shifted and the remainder is following whatever traditional pattern it's had, and in the aggregate we're observing.
Forgive me, 50% of what activity? Certainly not 50% of all innovation going on.
No, 50% of the financing of early stage companies. So I'm speaking about the financing of early stage companies exclusively. Okay, so that's so yes, it is, the patterns occur because we're talking about a dramatic change in half, where the rest of it has maintained a traditional model. The main sources here, I believe, are specific to software, right? We're talking about things now. Some of these movements exist in other places as well. So the open source movement that drives down the cost of developing the product is one. The storage mechanism and the use of data on the cloud, that cost is specific to software described here. We haven't necessarily seen the same patterns elsewhere. And then the marketing side being a third. So yes, I'm speaking specifically about software trends that are driving the overall pattern because they're a large portion of the activity. And the third question, I think it is explicitly a shift from an ex ante selection model to an ex post model as a way to deal with the uncertainty. The idea is, in general, people don't really think that they can predict under the uncertainty. The earlier you go, the harder it gets to predict. If the cost goes down enough, pretending you have foresight when you don't may make less sense than placing a lot of bets and seeing what happens. And I think that's the observed phenomenon, at least on the software side.
Fred Sauté.
All right, it's called Fascinating Work. Just one remark to start. When I ask my students what entrepreneurship is about, often enough nowadays they say it's about making apps. So apps have become so big that it's indeed software and apps is what entrepreneurship means to them in many ways. It's been a while that it seems to me that venture capital funds have not been involved in early stage financing. I mean, to my knowledge, prior to 2001, Dell Computers would be the big example that everyone would give, saying that VC was involved in Dell from day one, but most of the time VC was not involved until 2, 3, 4 years down the road. So if that's the case, are you saying this phenomenon has actually even become worse than it used to be before 2001? So that's my first point. The second point is that it seems to me that your story can be framed maybe as a not only a reduction in the production cost of software, but as a reduction in transaction cost of financing in general. Because the big difference between VC and angel investing is that VC invests other people's money and angel investors generally invest their own money. So if you're saying that there's less VC, it means there is less intermediation, financial intermediation in the financing of software startups than they used to be, which means that the cost for a single individual angel investor to do this has also gone down, which is very interesting. So these guys can not only do more of it in their neighborhood, they can do more of it very far away from their home, as you said. So it seems to me that the whole story is one of reduction of transaction costs and financing for some reason that occurred in the 21st century and has accelerated since then. I mean, I think it's very interesting for the VC model because the VC model is really one of limited partners who have very high knowledge of the industry and so on and so forth. And if this is crumbling, I'm really surprised, and that's very interesting news to me.
So let me deal with the second one first. So I think this is actually about multiple kinds of costs going down and there being kind of co-evolution. And so I'm not trying to describe, I may have made too strong a case to try to say that the cost of the software is driving everything else. We see a pattern where the production cost goes down, also the marketing cost is going down, and that because those costs are going down, the number of people engaged in the activity is going up, the number of people needing small amounts of money, right, has shifted. That changes the transaction cost model, right? The transaction model, I need to get a lot of people a little bit of money, which is not done well when a few people are giving out large amounts of money, so we need new institutions to make that possible. Now, as the new institutions come in doing that, are they contributing to the reduction in the marketing and the production costs? Probably too, because some of these companies that are being funded and developed are in fact feeding back into developing that. So yeah, it's going down. But so what's happening is a crumbling, in fact, of the system. And what's ironic is this is one of the first papers I've ever done where I've cited virtually no academics and a whole bunch of practitioners, because the practitioners are in fact writing about the fact that their industry is crumbling, right? So the venture capitalists are saying our industry is crumbling because we can't keep up, our models don't work. On the percentage of the early stage, what you would see is for the, in the 80s, venture capitalists actually did early stage financing, like, half of the money and half of the activity was venture capital. And you went down into the 90s and
do you mean less than 1 year, or is that what you mean by early stage?
I mean at the stage of the development of the business. So that would be, say, pre-revenue or very small amount of revenue of the business at the stage of the development of the company. And then in the 90s, that declined some, and in the early 2000s, the amount started accelerating. So what we see is, over time, it's always been declining. The slope of the decline has accelerated. Now the percentages are really low, low to points that we historically haven't seen, right? the idea that institutional venture capital firms at that early stage are at 4% of deals or dollar value. Like, we go back to the statistics that start in 1980, we haven't seen them before.
Rebecca.
So this is so interesting. I have a bunch of questions. One thing that I'm wondering about is about your taxonomy here, because it seems like these angel groups start to look more like VC, right? It's not like, you know, there's a group, there's some sort of institutional structure that is gathering up people's money and handing it out. And I don't know what micro VC funds are. I'm not sure I understand what what delineates these categories. I'm also kind of wondering about, I know you feel like the legal changes don't explain much, but I'm wondering kind of what those are, and if there are legal differences between as to who, like, could I just give some money to one of these angel groups and become a little micro angel, or are there? I mean, what are the regulatory boundaries that shape this taxonomy?
Okay, so let me try to deal with each of those things. So there is a legal and regulatory distinction between the entities. So the venture capital firms of any kind are legal entities that are raising money from their own limited partners and then have a fiduciary responsibility when they're investing on behalf of the others. And the angels are investing their own money one way or another, and therefore whatever structures they're using, it's their money. They haven't raised it from some endowment or something else, right? So that's a somewhat clean delineation. The micro VC distinction is less structurally clear because it's about the size, right? And so the statement that we make investments of $5 million versus make investments of $500,000. Well, that sounds clear, except that you probably have a continuum, right? Well, someone's at 4, and someone's at 3, and someone's at 2, and someone's at 1. And the idea is that the micro venture capital firms were firms that organized for the purpose of raising money with an explicit fundraising strategy to their limited partners that said, we will not make investments larger than, and those numbers are probably, most of them, the modal number was 250,000 per company, right? And we will make a volume that is much larger, going between 50 and 100 a year. So that's the distinction. That's that side. On the legal changes, the part that I didn't really have to go into was, if you try to map the timing of any changes that you saw on the legal side with the timing of these changes, it matches worse than the timing of the cost of software and this production and marketing costs, because these trends seem to be moving downward over time and these other activities rising up. The legal things are a couple of distinct periods. So prior to 2010, we had a period from like 2000 and 2010, we don't have a lot of changes, right? And then in 2010, we start getting some of the changes with the amount of money it took to be considered an accredited investor, trying to move that up in the direction of indexing it for inflation, which failed. But so the numbers, the amount it takes to be an accredited investor in real terms is much lower than what was originally put in the Securities Act in real terms. So there's many more people who can do this. But these those are continuous changes having to do with people's, with just the wealth of people. The legal changes are all post-2010, and it doesn't follow the pattern. It seems more plausible to make the story that eventually these patterns were so powerful and causing so many institutions to want to be developing that those institutions, like the people wanting to do online platforms, lobbied for regulatory changes to put them in place. So the cause was not them.
Felix.
Okay, thank you. Thank you for your nice presentation. But looking at the graphs, I missed something about the global financial recession. is there any correlation between this structural change you refer in your presentation and the global financial crisis? If so, to which extent financial turmoil and changes in the financial sector have forced this kind of innovations? I guess that there is some kind of co-evolutionary processes between these sectors and the financial one.
Right. So the data is not strong enough to make a clear case to say there isn't a place for a financial crisis playing a role. And some of the numbers could have been affected by that. It seems, though, that some of this is not consistent with that. So if you look at the patterns for some of these things, we see rises in the years between, say, 2000 and 2007, right? And then the slope of the line is not all that different from 2007 going forward. So if you look at accelerators or micro VCs, there's not like a huge shift, right, that goes down because now we had a recession. The other thing is that if the recession was driving the behavior, the recession's main effect should have been that these individuals were all poorer feeling, right? We had a big stock market decline. They should have all felt poorer, yet the angel activity is rising. So I don't want to say this too strongly because I don't have strong enough data to say it. It seems less consistent that the financial crisis was driving that. The declines in the people working in the venture capital industry between, say, 2000 and 2007, in terms of the number of professionals, was going down. Like, that's an era when, housing prices were going up and things were good, right? Then they continue going down at a similar slope, maybe a little stronger, post-2007 to 2012. Doesn't seem like a financial crisis story.
All right, and your answers are great, and I'm going to have to encourage you to do more concise because we've got 8 people left. We've only done 4 so far, and we've got half of our time left. So Jason Potts, please. Thank you.
Yeah. So the way you've framed these empirical facts is as falling costs per unit of software product, right? Which then raises the question of why have those costs fallen? But I'm wondering whether an equivalent interpretation of those same facts is that productivity of capital has improved, in the sense that what we might be looking at here is actually that it's the product definition that is changed and evolved. And an explanation for that is just a kind of Paul Romer type thing. The more products you find, the more you will find, because software products build on software products. So it may well be that this isn't actually a cost story, but an evolving productivity story.
I mean, it is possible. It's just that if it was an evolving productivity story without the cost, then we should observe it without the cost, right? I guess the fact that it's the cost combined with the pattern suggests that the costs are influencing the pattern, right? It's possible that those things are both there, and it is simultaneously this productivity story, right? And this is software products are getting more software products at the same time as the cost structure is going down, and both stories are there, and I'm only telling one of them. It seems less plausible that it's productivity, but we've got the cost going down, and that should be ignored.
Jonathan Barnett.
Like this very much. Just 2 quick questions. I wonder if what's happening, is it possible that the VC funds actually now prefer to enter at a later stage because the function of the angel investors may be to weed out the loser firms, and then the VC funds don't have to invest at the same level of diversification in order to hedge against those risks? And the other question is it possible that on the entrepreneur side, they prefer to work with the angels rather than the VCs because they don't have to give up as much governance and as much upside to the angel investors?
Okay, so now I'm completely beyond anything I've written, and I can tell you other things that I might have to add in. So I believe that I think that these things are all evolving in reaction to each other, right? So the VCs say, oh, look, our old model doesn't work anymore. These angels have gone in. These angels have now taken on this earlier stage risk. We can raise a lot of money that we're good at, and we can make bets and monitor these companies later. So our model would work later. Maybe we should move later in response, right? So I don't want to say that, that's not there. I think that all of these are reacting to the same trends, and they're all working in a sort of non-competitive, cooperative way that the system, this ecosystem, is evolving in that way. So yes, it would be consistent that VCs can't really do this at the early stage. They can do it well at a later stage, so they're moving there. In terms of the entrepreneurs preferring the angels, what's interesting is that some of the governance mechanisms and the contract structures of the angels have become more and more venture capital-like, so that gap is smaller. So I'm not sure it's a sort of preference for the angels, because the angel of today is giving a contract that looks like the venture capitalist of yesterday in the contract.
All right, time flies while we're having fun. We've got 7 people and 8 minutes, so Frank.
So I'm going to make actually maybe more of a comment, though I would like your thought. I think the notion of evolving productivity is actually spot on, and I think that it is the combination of the declining costs, as you highlighted, in open source and in hardware and cloud, but we're also realizing at the same time radically improved productivity of software developers. We're seeing the benefits of 20 years of modularization through object-oriented programming. We're seeing the ease of software assembly as a result of that, as well as with visual tools and language abstraction. And then there are just a million application programming interfaces and software repositories, both open source and for-profit, that these developers can take advantage of. So I do fundamentally believe it is maybe more of those two things together. And I'd like to offer maybe something to think about for the future. I think we're starting to see this in hardware now too, in the sense that we're seeing, and I'm seeing it here at NYU and in the market, that we're seeing teams create hardware startups that they couldn't have created, even 5 years ago or 10 years ago, because the component cost is going through the floor at the same time as the tools to access them are more accessible with microcontrollers like Arduino, and now they can make their components to hold the microcontroller on a 3D printer. These things were inconceivable, from an economic, or untouchable from an economic standpoint for an entrepreneur in a garage or a dorm. So, any thoughts on that?
No, I'm convinced that this is probably a collective story of costs going down and productivity going up. And the two of you want to join me, we can make it a 3-authored paper or so.
Franco.
I think this is a great presentation and very, very stimulating. I like very much the idea of technology, structure of actors, institutional change, and coevolution. And I want to follow, a lot of questions have been already raised. I want to follow up what Jonathan said. The flip side, let's look at the new ventures. So the new ventures are much more in terms of numbers that are funded. They have less control from the funders, the financiers. But then there is a third mechanism I want you to clarify a little bit, in a sense, with the previous venture capital, they had a knowledge structure in terms of coaching, advising, and so on that was, in a sense, distributed to them in various ways. Did this change with this different structure? Were there, in a sense, more alone, less knowledge, diffusion, and transmission from the financer to the new ventures?
May I violate David's rule? We've got about 4 people left and 3 minutes. Do you want one question per one response? What do you want, David?
Well, the main thing is that we don't go over time.
Right. So let's just have the people ask their questions because we only have 3 minutes. So
keep their questions very brief.
Yes,
maybe more in the nature of a comment.
Leah, were you on the list or you just were? Okay, Leah. Then yes, please. Well, we need it for the recorder. Yeah, could the other people turn off your mics? Sorry about that.
There we go. So I am wondering, and this is to follow up on a earlier question, whether you're seeing the same pattern occur in biotech and medtech companies. And the reason I'm asking this is because their costs are actually been increasing. A lot of it is regulatory costs. And if you see that maybe you're not seeing a lot of angel investors and more VC type stuff there, and you're not seeing the same pattern, that might strengthen your argument in that case, because then on the medtech and biotech side, the costs, at least from what I'm aware, have been increasing.
All right, we've got 3.5 minutes. Richard Epstein, not for you, though.
No, but just one of the things that you didn't include in this paper is sort of the value of the various outputs. So if you start looking at, for example, the kinds of patents that are obtained and the companies that are formed, do the little companies make little patents, or they make big patents? Do they have huge inputs on with respect to market? What's the market capitalization of these firms when they come out? Because I'm just always wondering about the question as to whether or not you may be switching to a Navy, and the way in which you describe it is you've gone from 10 destroyers to 100 destroyers, but it maybe you've gone from 10 destroyers to 100 patrol boats, and I just don't quite understand which way that actually works.
Raul.
Yeah, just a brief question. The declining strengths, the question about the declining strengths of developing software, is that specific into the United States and also, or greater or lesser magnitude in elsewhere, Asia or Europe or Israel, for instance? It's the globalization of this decreasing trend in developing the cost.
Mario. David, and then we're done. Okay, we've got 2 minutes now. You can respond to all your questions.
Okay, so the first question. So we see a shift in the governance structure fundamentally that's co-evolving as well. So the venture capitalist structures sit on the board of directors, and now this doesn't work when you have 100 companies, right? So what you're now seeing is mechanisms to try to be set up that govern differently than sitting on the board and having board meetings, which is to kind of have them, force them to use standardized information flows back to the investor, have regular meetings of groups in different ways. The accelerator model is different than venture capital on the meeting. So that's the answer to the first question. The second one on this, so med tech is tech, and I think follows the same pattern, but medical devices and biotech drugs is completely different. And you do see, and that would, I think, strengthen the argument, this pattern is not true in those places, right? Angel's actually getting out of those, and that's decreasing on that side. The third question, so these are mostly companies that don't have patents. There's nothing to measure on patents. These are not tiny companies, right? Examples of the companies that we're seeing that go through this new model are like Dropbox, Slack, Airbnb, right? Uber, right? Those are companies, right? So the dollar value of them is big, right? The global pattern was the last one. It's pretty much the same. In fact, what we're seeing is that these very institutions are going overseas. So you have the largest micro VC fund is actually in France, believe it or not. The accelerators are moving to pick cities everywhere. So there's, going to a London and a Berlin and a Monterrey, Mexico, and so forth as the model. So seems to be the same everywhere. Obviously, places which have a lot of drugs and medical devices are following different patterns.
All right, that concludes our 45 minutes. Scott, great research. Thank you.